There's going to be a lot of value that's going to be discussed today. On my way up here, one of the people reached out to me and says, hey, are you going to be doing that money tank thing? Is Chris doing that money tank thing? And I said, yes. I said, well, what are they going to talk about? Well, I said, it's going to be Zach. And I got the privilege to see Zach speak last year. And some of the things that he talked about were good if you were just getting started in the real estate game and learning how to use the tax code to your advantage. And then it migrated to higher end stuff. And I was like, I really want to use that stuff someday. And then, of course, it escalates more and more and more. So the key thing is that whether if you are a first timer or you've been around the block and you're on your 85th door, you're going to get a big point of value listening to what Zach has today. And right now, we're already planning for next year. We're already got our tax strategies all set up. We're looking to see how can I keep as much money in my control as possible. And you know what's going to be great is that Zach's going to be one of the guys that's going to teach you exactly how to do that. So guys, give him a hand. Zach.
Thank you. I'm going to do my best to match that energy for the rest of the night. I know that taxes can usually put people to sleep. Not very, very interesting. So, yeah. So as he said, right, this is going to be very, very real estate focused. So it's going to be talking about long-term rentals, short-term rentals, touching on flipping properties and basically the tax advantages or how to make the most advantageous tax situation out of all of those, the different ways to do that, depending on your situation, the categories and the different pieces there. So we'll be able to go into a whole bunch of topics. Anybody who's online, I know that's going to be monitored for any questions. There'll also be different times throughout that jump in, ask questions, feel free to do that and as we go here. So again, some of it, if you've been in real estate for a while, some of the early stuff is going to be stuff you know, but for those who are just wanting to get into it and want to learn a bit about the basics, I cover a little bit that here before we dive crazy into the information. So if you can hit that for me, please. So I'll first start a little bit, I guess, about me is the basic. I've been a CPA since 2014. Worked corporate world for the most part up until 2022, but had always done some side work with a bunch of real estate investors that I had met through RIAs, being a real estate investor myself. So I've been CPA since 2014, but involved in real estate myself since 2007 is when I bought my first property. So this is something that I am in with you guys, right? So I am experiencing many of the similar things that you are, that you're coming across, tenant issues, broken sewer lines, whatever it is that you're coming across. I'll be able to talk specifically the tax thing, but I'll know, right? Well, every CPA that you work with is going to know tax code and how real estate should work, but they don't have the ins and outs, right? They don't look deep into the strategy of, hey, am I going to want a 1031 this later? How do I grow my portfolio? What are the things that I can take advantage of now to expedite the growth and look at the full wealth piece of it rather than just the tax code piece of it? It's the world I've been living in. The reason I was able to retire from the corporate world in 2022 was because of the real estate portfolio that I had built there and taking advantage of the tax aspects for that. So my CPA firm, it is just me. I specialize in real estate investors, small business owners, usually those cross over, right? That you have both of those things going on. And the tax preparation thing, 90% of it can be done by a trained monkey. I always say, right, it's a software. You put the numbers in where they're supposed to go. It spits everything out. It's that extra 10% that is then determined during the rest of the year when we're doing advising, when we're planning, we're talking about the things to implement, the goals, how to work through. Do we want to bonus depreciate? Do we want to buy that vehicle this year? Different things like that. That is the extra 10%. But it's focusing on the planning and advising during the year. That many tax preparers will take your information in April, do your taxes, hand it back to you and say, hey, I'll see you again in a year, where I want to be the one who meets a couple times a year, talks about the different things that we can take advantage of. So First, we'll just talk about we'll do the advantages, the very basic. We'll talk about how rental real estate can help you and how that works tax-wise, right? First thing that people get into is cash flow, right? That's the reason why you think about buying rentals, right? Is hey, I want to live off that passive cash flow later in life, right? This is my retirement plan. So that's what most people are getting into it for, is because that's the goal. So basically here is just the cash flow is your rental income minus all of the different deductions that exist. They're all up there, right? Your cleaning, maintenance, your repairs, your real estate taxes, the insurance you have on your properties, paying me, different things from there, your travels, your meals. So that's just kind of the full list of, not full list, but a partial list of the different deductions on what goes into cash flow. But that's right, that's the money you put in your pocket. So that's just the first piece of real estate, right? That's what we see on a daily basis. You get your income, your rental income at the start of the month. You know what's coming out with your paying with your mortgage or any repairs that you have. And you're like, oh, cool, that's what I got cash flow wise, and that's what I'm profiting. But there's more to it, right? So then there's the next piece, that's the tax piece. And these are very much the expenses that are missed because you're not coming out of pocket with them, right? You're not writing a check. You're not using your credit card to get these. So there's other expenses that you can take that don't affect your cash flow, but do affect your cash flow on your taxes, right? Your bottom line, what you're showing as a profit. Two of these are, and we'll talk about depreciation in a little bit, is going to be auto, something that's commonly missed. Two different ways that you can do it. Your mileage, it's going to and from the properties and going and visiting, and anything that you maybe Home Depot runs, different things like that. You have the basic mileage example that you can do. Or if you have a vehicle that you use for more than 50% business, so if your rental business you use that vehicle for more than that, there's an actual method that you can use. It's complex. You take your percentage of usage, multiply it by basically all of your vehicle expenses, something that, depending, takes some tax planning, could be more valuable if you don't maybe drive a lot of miles, have a high dollar vehicle, or the mileage might be more suitable if you have a very high gas mileage vehicle, you drive a lot of miles and you take advantage of that. Other one is going to be your home office. So if you do this business out of a home office that you may have set up, something that's set up solely and primarily for, solely and discretionary for this business, is something that you can then also take a home office deduction, as long as you're considering your real estate as a business, which if you have it in an LLC or you're actually making money off of it, right? Very easy to declare I'm doing this for business purposes. And for that, you can do flat rate, which is basically $5 a square foot, maxed out at 300 square feet. So you can't take more than a $1,500 deduction for that. Or there's an actual method that, again, that same business or the percentage of your house that home office takes, you can then take that percentage and multiply it by your real estate taxes, your insurance, your utilities, mortgage interest, all of those pieces. So it can be a much larger deduction, does require more tracking throughout the year, also allows a portion of depreciation as well. So, but these are things, right? No money coming out of your pocket, or stuff that is personally coming, you still have your vehicle, you still have your house. Those are things that you're going to have no matter whether you're rental real estate or not, that become additional deductions that nothing is changing in your life, but you're able to add on these things, right? There's more that are on that list, but that's a big piece. And then the big one that exists, right, that is an expense that you can take but doesn't affect your cash flow in the slightest, is depreciation or amortization. So this is when you purchase a piece of rental real estate. You're going to be able to go and at the time you're going to declare, and there's a few different ways that you can do that. You have the purchase price of your home that you're purchasing is going to be a portion to building and a portion to land. The land piece can't be depreciated. The land will always be there. You can't say that the land is getting less and less valuable, right? But the building does, right? As it ages, it depreciates in value, even though we know it appreciates actual value, but the walls, the building materials depreciate over time. So as something that is a benefit for real estate investors is that you can depreciate or take as an expense over time the value of that house that you just purchased. So with residential real estate, long-term rentals, it's 27 and a half years. Some short-term rentals and commercial buildings are 39 years that you can take that building portion and depreciate it over that time. That's an extra expense that you can take, but isn't money coming out of your pocket because, as we know, part of our cash flow is that mortgage, right? That's being paid. We've already figured that out at the start. This is then an extra benefit extra write-off that you can take, but isn't affecting that cash flow at the start. So we'll get into cost segregation and bonus depreciation later, right? This is something that has changed with the One Big Beautiful Bill Act that has returned, that makes depreciation a huge tax planning measure that you can take advantage of now. But this is something that is technically normally a straight line, right? You just take that whole building, depreciate it over 27 and a half years, and you get that benefit as a straight line over the course of time. And as you can see, just a depreciation amount annually of $3,000. If you're in the 35% tax bracket, that's an extra $1,050 that you're going to get back in taxes by being able to take this depreciation at that tax rate. Go next. So breaking this down, just a general example of how most rental real estate investors cash flow, right, have a profit, put money in their pocket, but when you have your tax reporting, you're actually showing a loss. This is kind of the goal and the whole point, right, of doing it. You get the cash flow piece, but you want to not pay as much tax on it that exists. And this is one of the few worlds that exists that you don't pay money on the cash flow. You have what's considered, you're paying taxes on your tax profit. And as you can see, you could have $3,000 in a year that you're putting in on cash flow, but when you take that $1,000 in your home office and your vehicle, and then the depreciation and amortization that exists there, you can have a $2,000 loss on your taxes, but you actually made $3,000 off the property that year. So this is huge. That you're trying to generate tax or cash flow while not paying tax on it. Real estate's one of those few worlds that you can actually do that. But go to the next slide. On that, can you take that loss, right? So there's, right, on the surface, it sounds great. And you can take that loss that we just showed and have it, say, carry over and offset. Maybe you have a W-2 job. Maybe you own your own business. Have other maybe interest income because you do private investing or have dividends or different things that you're receiving money from. Are you able to take that loss that we just showed on that last page? Just like everything tax-wise, depends. And so this is where you really can get into the weeds, and we'll go through a lot of this. And this is where a lot of, I have so many new clients or people that I talk to that say, hey, I thought I was going to be able to get this loss, but I went to my accountant and they said, actually, you can't use your losses this year because this circumstance or this circumstance or this circumstance. And people get into it thinking they can take the loss, but you have to check boxes to get there. You have to qualify to actually take those losses against your income. And we'll go through the different ways to do that. And how that is very different for long-term rentals and for short-term rentals. There's different boxes to check depending on what it is that you're into. A lot of it comes into active income and passive income. So the IRS declares your income, all the money that you bring in, is it active or is it passive? Real estate, for the most part, in many cases, is considered passive. So for most of us, right, we go and we handle the maintenance, but for your tenant's paying you the income. You're not there every day. Rental real estate on the surface is typically passive, which is different than, say, if you run your own business or if your W-2 job. Those are considered active income sources, right? You have to go to them every day. You have to work for them to be acquired. The IRS says, well, rental real estate, you're not really working on a daily basis to do it, to make the money off of it. And that falls into a passive category. And so per the IRS, passive income and passive losses are supposed to be matched up active income and active losses are supposed to be matched up, and very rarely can you cross the bridge, right, for those two to qualify. But in real estate, there are ways that we can make that happen if done correctly and go through. One of them is real estate professional status, but there's going to be other ways to be able to do that as well. So we'll talk about long-term rentals first. We'll go into this. There is basically 3 categories of long-term rental investor, right? So this is where you're going to have the 3 different thresholds of how that loss that you're having on your Schedule E, which is where your rentals are happening, and can it be used against your active income or the other income that you have going on there. The first bucket is it's just passive activity, right? So this is, you hire a property manager, you buy the property, you hired a property manager, and you never touch it again. You look at your reports once a month that you get, but you don't make any decisions. You don't instruct your property manager to do anything. You basically hand over the keys and tell them to do everything. You are as passive gets. This would also be if you're, say, doing a syndication or investing as part of a group where there might be, like, say, a partnership where somebody else is making the decisions and they're the active participants or the active owners, and you're passive. You don't make any decisions. You don't do anything. You just collect the income at each month that they distribute or a year. So with that, that goes very much like we talked about the passive. It constitutes as passive, and you can only take that loss up against other passive income. So if you maybe have other syndications that you are profitable in, you can start to offset that, or other businesses or other things that you may be passive in and receiving income. You could only take those losses and offset that. If you have a W-2 job, if you run your own business, you're not going to be able to take those losses against that income to lower your tax liability. So you're very, very restricted on that passive level. The next level is if you're an active participant. So this would be, you can still have a property manager here, but is your property manager then coming to you and say, hey, we found this candidate for your rental. Do you okay them, or do you say no? Are you okay with this rental increase? Do you want to extend the lease? Like, they still have to check with you for most of the activity. Like my property manager, any expenses over $500, they have to come to me and get the okay first. I have say in turnovers. I do have final say in tenants. I just had them come to me last week and say, hey, do you want to take this Section 8 applicant? But they have to have a rent reduction. And so those things, you're passive because you're not involved in every day of it, but you're still making important management decisions or making some repair decisions, going and making phone calls, doing that and being on top of it. So being involved with that allows you and puts you in this active participation. So you're actively involved in parts of it, but still could be at a distance, or this could actually be if you don't have a property manager and you're just still doing the one that's doing the showings, making decisions, doing the repairs, right? Or you're the common landlord who's dealing with all of that. You will fall into this active participation category for the most part, unless we get to the next one. So what that allows you to is that if on your Schedule E, $25,000 of those losses can be used to offset your active income, but it's capped at $25,000. So if you have $50,000, you'll be able to use $25,000. And so in each of the 2 passive and active categories, that doesn't mean that you lose that loss and you're never able to use it. It gets held up on your tax return. It carries forward until you can either use that, right? If you have passive income, to use that against, or maybe you sell that property, you can use it against the gains on the sale of the property, or other different things that you may have going on. So you don't lose the ability to take the loss, you just lose the ability for the current year for that. So you can take up to $25,000. The thing that most people come to me and say, I was never told this, is they said, I thought I was going to be able to take those losses, is that if you reach $150,000 in income, you lose the ability to take that. So starting at $100,000 of income, your ability to take that goes down $1,000 for every $2,000 you make, from $100,000 to $150,000. So that's where that 25 gets eaten up. So you can, if you make over $100,000, you're going to be able to take part of the 25, but not all of it. And then once you reach $150,000 in income, that $25,000 loss, again, doesn't disappear forever, but disappears for the ability for you to be able to actually use that in that year. And that is the biggest gripe or the biggest conversation that I have with people, or people who are wanting to use me as their new CPAs, because my old CPA never told me this. I made $300,000 this year. I invested in real estate because that's what you're supposed to do when you make a lot of money, is you buy real estate, you use it as a write-off, and it starts to offset it. And then you grow your wealth that way, right? And I was like, well, you're growing your wealth that way still, but you're not getting to take advantage of the tax piece because you make too much. So the losses will still exist, but they just won't be able to take it until they either quit their job, right? Stop making money, or drop below that, or sell the property, and then your losses that you've accumulated over time can offset that property. But where you want to get, the status that you want is the third one, is qualify for real estate professional. This means that loss can be $25,000, $50,000, $100,000. You do a cost segregation, it's maybe $200,000, and you can use that loss that exists, that was created mainly or potentially solely by that depreciation piece, and have it offset all your active income that you have there. So there's obviously some hoops you have to jump through to be considered a real estate professional. You can't just say, hey, I own a couple pieces of real estate, I'm a real estate professional, right? It's not that easy, not something that we can do there. So the rules are that what you're spending in, the time that you're spending in the real estate field needs to be more than half of the time that you spend in other activities that are generating income. So if you say maybe have a business, but you're only in that business like 20 hours a week, you have to be spending 21 hours a week in real estate to qualify for that. There's 11 different categories of what qualifies as real estate. So it can be as a landlord making those decisions, doing all that. It could be as a contractor, it could be a property manager. There's a realtor, like there's different things that can qualify as real estate professional status, but you have to make sure that whatever field you're working in is more than another income driving field that you're working. Also, caveat is this: you can't be a W-2 employee. So if you work for a plumbing company and they pay you a W-2 as a plumber, you're not actually, those don't count for real estate activity, right? That doesn't count because you're getting paid by another employer to do that. You have to be at least a 5% owner in that company for the time that you work as an employee. It counts as real estate activity. So if you're, like I said, if you own your own plumbing company, right, you're gonna, all hours that you do in the plumbing world is gonna count as the time here. But if you say work for a T-Mark or a Roy's or something like that, you're not going to qualify. And the next step is that your time needs to be 750 hours or more during the year. So it does require you to track this during the year. I'm not going to check it if we're filing the taxes, but you better, what I'm going to ask you, do you have this time logged for if the IRS does come knocking and wants to audit this, that you do have proof that you did reach the 750 hours? And if you did have other activity going on, did you also track those hours to compare the hours against each other? So you need to be at least 750 hours, and it needs to be more than half of the time spent elsewhere. And then the losses that you generate on your long-term rentals can be used to offset that. The ideal situation here that works is, and kind of how we talked about there, you can have a very high spouse, your spouse, right? One of them can have a very high income in their W-2, and the other spouse can qualify for real estate professional, right? They can be a realtor, they can be managing the rentals, making sure they get the 750. And so those losses in your real estate can now offset that W-2. So you can still have somebody in the household who has that W-2 job, but as long as the one person is qualifying and you're filing jointly, you can use the losses on your real estate to go against it. Both people don't have to qualify, just one with that as it goes through and does it that way. So I know the thresholds. I hope that makes sense of where to qualify, and really depends on your activity there. This is kind of one of the most confusing pieces that people just think they can take the real estate losses. And you can, but only if you check a few of the boxes on that. So, any questions so far?
So what if you create a property management company now, right? Do you get to take you get to qualify as a real estate professional?
Again, as long as you're spending that 750 hours in that, and that you're not doing another activity that's higher than that. So if you're either one managing, you can do it managing your own properties, but you've got to have probably quite a few properties to reach that 750 hours. Like reviewing financials, looking for a property doesn't check that box. You have to actually be doing repairs or meeting repair people there. You actually the administrative work doesn't usually check this box. You actually have to be actively doing something. So if you run a real estate management company where you're managing other people's rentals, that would most certainly qualify as a real estate profession. Then you just have to reach the other two thresholds.
Okay, but not your own, right? Yeah, it has to be other people.
No, it can be your own, but you have to still make sure you get to that 750 hours, and there's no other time that you're spending on a separate activity.
Wow.
So it can be like if you have 30 properties and you're managing those yourself all year round, I'm going to say you're going to reach that 750 hours. But if you only have one or two properties, I'm going to say it's probably very tough for you to reach that 750 hours. Not saying it's impossible, but you're going to have a tough time reaching that threshold. And saying you're spending more time managing one or two rentals than you're doing on any other income generating thing that you're doing. Yeah, does that make sense? Okay. So that's long-term rentals. So next we'll get into short-term rentals, handled completely different. Of course, why IRS make it easy, but short-term rentals is where you can actually see the most significant tax savings on this. It's considered the short-term rental loophole. You may hear about that. The thresholds to have your losses count against your active income are much smaller. You can still do it if you have a W-2 job. There's ways that you can qualify as a short-term rental on a short-term rental than you can on your long-term rentals. Doesn't use the real estate professional status. That's kind of taken out of the equation here. We're going to use different terms. Material participation is the big one here, as opposed to real estate professional status for short-term rentals. So we're going to have a couple terms that are involved here. The first is going to be substantial services. So substantial services when it comes to rentals is going to be, kind of think of a hotel, right? It's going to be that you're changing linens daily, you're providing concierge services on a regular basis, you're making deliveries, you're kind of acting more as a hotel, right? You think most short-term rentals, you're usually just changing the sheets on before they start to stay there, right? And then you're taking them out afterwards. You're usually not cleaning daily, you're not doing those kinds of things. If you are doing those things, you're falling into substantial services, and what that means is that you're running an active business. You're in it daily. This is not a passive activity. This is an active business. And so not only does that flow through on the Schedule E, which has usually some protections, you're actually going to flow through on a Schedule C, which means you're self-employed, and then you're also going to pay self-employment tax on this income as well. So this is substantial services is something that you can provide and can do that, but then you're really considering yourself an active business and exposing yourself to more taxes doing it that way. If you have a bed and breakfast and this is part of your model, right, that you stay on site and you do make breakfast every day and you do that, great, right? If you're cash flowing, you're making money and you're doing well, that's great. You're just going to get taxed more on it. Because you're providing these services. If there are no substantial services, then the next test is material participation. And so for material participation, so the other piece that's going to be key here is your average rental length. Is it 7 days or more? I'm sorry, less than 7 days or more than 7 days? Both of those have different handlings. If it's more than 7 days, usually that's when we're starting to talk, okay, you're falling into long-term rental status. If you're less than 7 days, then you're going to start to be considered in the short-term rental world. So if you're not providing substantial services, the next test is material participation. And this is the one that you want to check. This is the one that you want to have. This is the real estate professional status of long-term rentals for the short-term rental stage. So there's 7 tests of way to qualify. The top 3 are the ones that are usually the ones that are most easily accessible that you can get there. The first one is just more than 500 hours that you're doing in the short-term rental business. This, unlike the real estate professional status, you can merge the hours of you and your spouse. Spouse can do 250 hours, you can do 250 hours. As long as together you're doing over 500, you're reaching this threshold. On the real estate professional status, the 750 has to be done by one person and one person only. So it sees the familial unit, the spouses as one for reaching these thresholds. So the first is 500 hours or more during the year. Second way, we'll skip to the third one. The next one is that you participate more than 100 hours in the activity, but no other person spends more time in the business. So key pieces, this could be a property manager, this could be cleaners, this could be different things that you have going on in the business. So if you're not self-managing, you may have a tough time reaching this because you probably have a manager or you do have a regular cleaner that is probably going to beat the amount of hours that you have. Ways that people get around this is rotate cleaners. If they self-manage, right, they rotate cleaners so that they maybe have 3 or 4 that they use that none of them accumulate enough hours to outdo theirs. Or they're self-managing and doing visits and then they're doing, say, the repairs themselves or painting or doing things like that. And you only have to get to 100 hours if you're the one that's there. The second one is one that really comes into this is most met with timing. So they say that your participation is constituting substantially all the activity. So this isn't a comparative of more than other, and right, you have to substantiate substantially all, right? So you have to be able to show that. But that's basically saying, say I buy this property in November, I only have it for a month. I can't reach 100 hours probably in a month, but I had 2 stays in December. This will be part of a planning piece that we'll talk about in a little bit. In December, you couldn't do more than 100 hours, but you did all the work, right? You put all the furniture in, right? You did all that. You did the cleaning, the 1 or 2 stays, or make sure it's at least 2 stays. You did the cleaning during the 2 stays that were there. You did substantially, you managed it, you listed it on Airbnb or any of the other sites to be able to do that, where you did substantially all the work. You may not have reached 100 hours, but you did pretty much everything. So you can qualify that way for a property that you may have bought late in the year, which is what people do primarily for the short-term rental loophole that we'll dive into a little bit. On that piece, because this can be the way that you can really build this into and take advantage of it. Because to qualify, if you're say using this to then do what we talk about in a little bit, cost segregation, take all that depreciation, take that loss in year 1, IRS only cares if you qualified in the year that you're taking the depreciation and the year that you're taking the loss. So you can self-manage it for those 2 months. On January 1st, turn it over to a property manager, become completely hands-off. But if you're taking all the depreciation that first year, you're taking normal depreciation the next year and not taking the advantage. You qualified in the year that you're taking the additional expense and getting to do it. So people who are using this loophole, what they will do is they will purchase a property very late in the year, go manage it, do everything that they need to do on that property we'll talk about the cost segregation, they're taking their depreciation, they're taking it in that year, and then making it part of their portfolio, and then repeating 1 a year, every year to take advantage of this and check the boxes. The other 4, you can take a look at them. Like some of them is that you have to have qualified in one of the top 3 for 5 of the last 10 years. And as long as you've historically done this, you don't have to keep checking the boxes. So if you're regularly doing it, you just have to do it 5 of the last 10 years. And then there's IRS just has weird verbiage that just said, hey, if you've just been continuously doing this all year and nothing else and nobody else is involved, then yeah, we'll still, which I don't see how that's any different than the second one. I'm doing it, so.
Can the rentals be to, like the 2 rentals, can they be to relatives or not?
It should be third parties. To do that, if you want to use an extended cousin or something to that effect, I would say don't use it to your brother, sister, parents, children. But if you're doing it for a reasonable rate, right? Like you're not renting it for below market and it's something that was booked outside of your immediate unit. There's some gray area there. Ideally, you would want to have a third party that's booking it, but as long as you're getting market rates to do it and it falls into the other check boxes, you can potentially do it that way. So, and again, you can do 2 visits of a day each, right? So as long as you have to have that less than a 7-day average stay. So all you need is 2 stays, right, to have an average. Yeah. So, right. So that's how it works. Obviously, if you have a full year, you're going to take the amount of days that was rented by the amount of people who booked, and that's what you get to be your average. So say you rented it out for 200 days during the year. You had 50 renters throughout the year. Your average stay is 4 days, and you're falling into the left side there where you're clicking the yes. So this is the whole matrix of what we just talked about, and the tax benefits of checking some boxes and then the detriment of not checking some of those boxes. I'm going to try to go through this quickly, but with some of that. And so you want to try to be, you want to be first in this yes part. The no is more than a 7-day stay, and a lot of the benefits disappear because you're then at that point probably going to be considered that long-term rental status that we talked about earlier. So you have either, if you're providing substantial services, but a less than a 7-day stay, it's kind of the worst, right? Because you're going to be Schedule C, which we talked about, is going to expose you to that extra self-employment tax, which is an extra 15.3% on all of your net income. And so your Schedule C, and you're going to have that. You're not going to get to take advantage of the losses. And then if you do have income, you're going to have to pay self-employment tax in the year that you have it. So really, this is where an S-Corp strategy, which we'll talk about for flips a little bit later, would be the only way to really get involved in that and avoid the self-employment tax. So you don't really want to be there. And then if you have if you have more than 7-day stay and you're not providing the substantial services, essentially you're just a long-term rental. It's on a Schedule E, the same as a long-term rental, and that's how it's treated. And there's really, you're not even talking about short-term rentals anymore. So this would be very much like maybe your midterm rentals, right? If you do housing, corporate housing, nursing, different things like that are doing 3 or 6 month stays, that's just going to be like a long-term rental. You're not falling into it. Where it matters is if you have a less than a 7-day stay, and then we're going to talk about, are you providing those substantial services? If you are doing the substantial services, you're again kind of still falling into the Schedule C, and going to be subject to self-employment tax, but you are going to be able to do the cost segregation, be able to take the big amount of depreciation. So you don't lose all of the benefits here, but you do expose yourself that, yes, you may be able to set it up and take the big losses this year, but if you in the future are going to start making money and showing profits on there, you're going to want to then try to get out of this strategy because you're self-employment tax. The big pieces are then, if you're not doing the substantial services, which most people don't, and you have less than a 7-day stay, if you don't have material participation, you're going to be Schedule C, and you're going to have that self-employment tax, the extra taxes, you can still take those losses from the depreciation and be able to still have that pass through and go against your active income. But when you start to make income, again, you're going to be Schedule C. And also when you're typically on Schedule C, your depreciation is 39 years, not the 27 and a half years like most rentals. So you're going to also get a slower depreciation schedule when you're looking at it that way. Where you want to be, the best of all worlds is what we talked about, is if you have a less than a 7-day stay, but you check that material participation box, just as when you had that real estate professional status on the long-term rentals, where you want to be on short-term, you are Schedule E, so there's no self-employment tax because that's seen as passive activity per the schedule, but you can take those pass-through losses, you can do the cost segregation, and you can take the losses that you have through there and pass them over to active. So this is the box that you want to be in if you're doing short-term rentals, and where that loophole exists is that less than 7-day average stay, and that you're materially participating in one of those 7 tests that we just saw on the last screen. That this is on a short-term rental, the material participation is the equivalent of being a real estate professional on the long-term rental side. They're separate, and you're checking different boxes. But as you saw from the last screen, the material participation boxes, that 500 hours, you could spend still like between, I point to you, right? Because we were talking about this a little earlier, the married couple, you could both have W-2 jobs, right? You're working 40 hours a week. Between the two of you, you can get to 500 hours in a year, right? That's 10 hours a week combined between the two of you, and that you can reach that number and do that if you're not going to take advantage of the timing or and that you can still, right, have a manager on that property. And if you're somehow still doing enough activity yourselves on it to get to that 500 hours, you're checking that box. And how that really comes in, we'll talk about this. These pieces are important, and you're not usually seeing those losses where this is planned for, unless you're really talking about, it's the depreciation piece that is usually driving the losses that you have on your properties. Whether it's long-term rental or short-term rental, the depreciation piece is the big driver for the losses that you can take on your tax return and really offset it. And it's the qualification. So you can still do this cost segregation and do bonus depreciation, but if you're not checking one of those boxes, you're spending money to do the cost segregation, you're expediting depreciation, but if you can't take those losses and you're still going to be waiting to take those losses until you sell the property or actually qualify, you're still, what's the point? So this is where it becomes the big planning measure on it. So a cost segregation, what a cost segregation is that you would have to hire somebody who is approved to do this, right? It's usually engineers, certain CPAs. You can't just do this yourself. You can, but when the IRS comes and says, who did this? And you say, I did, they're going to say, well, it doesn't count. So you usually have to, there's many in the industry who do these. There is a cost involved in them, but again, it's a cost that you can write off for your rental because it's an expense of the rental to do it. And it really it becomes a cost benefit analysis, right? Is the benefit that I'm going to get from doing this study far outweigh the cost of doing the study? And so it's there. So what happens is this engineer will come to the property, right? We'll go walk through. Usually when you buy a property, a rental property, everything in that house is 27 and a half year, and you just depreciate it straight line. But as we know, in a house, we have, yes, the roof and the siding and the HVAC is all 27 and a half year property, right? You can't take it out of the property. You can't take it with you. It's part of the building. But you have carpet, you have cabinets, you have countertops, you have different flooring, you have specialty plumbing, you have these things that are not, if you were to put them in after you bought the property, would be considered a 5 or a 7 or a 10-year asset that you get to depreciate differently than the 27 and a half year. So this engineer will come in and say, okay, of this $500,000 house that you just bought, there is this amount of property that is 5-year property, that's carpets. Maybe you have a brand new kitchen, so you have high-end countertops, you have high-end cabinets, you have all of those pieces. And so they'll go in and look at the difference, and they'll go in and segregate, right, the different costs into these categories. They'll have your roof at a value, and so they'll break it down that way. And so what this means is these are seen as different categories for depreciation. So you can choose to depreciate them in different ways. 27.5-year property, you have no choice. You have to streamline that to 27.5 years. It's an even amount over the course of the whole asset that you're stuck with. But by doing this cost segregation, you move some of that 27.5-year property into the 5, 7, and 10-year categories. Why that's important is bonus depreciation, which with the One Big Beautiful Bill Act just got brought back to be that bonus depreciation now is at 100% again. So you can 100% bonus depreciate any assets that have a less than 20-year life. So all of those cabinets, those countertops, the carpets, everything that was in that segregation that was not 27.5-year property, this could also be land improvements. So this could be landscaping, this could be a driveway, this could be a fence. All of those things are going to be part of that because that's 15-year property. It's going to be less than that, and you can then fully depreciate all of those pieces in that first year, in year one. So think about how much that could be, right? As you go through, and that's how you create those losses, because that depreciation can be a big number and can come through the loss. And so in most cases, I've talked to a bunch of cost segregation analysis, people who do this, they say typically the less than 20-year property is going to be about 15 to 25% of that building cost, right? So as you know, the land part, no, the building part that gets separated, you have between usually 15 to 25%. If you have a recently renovated property, that sometimes can get up to 30%. By speaking with them, I was told that Buffalo area, for the most part, what they see is about 17, 18% is kind of their line on what's going to be eligible for that. And so there's kind of I did an analysis here where you can see the difference is, say we're taking a $500,000 property, not one you're probably going to find in Buffalo, right? There's not a lot of those unless you're maybe buying a 4-unit or something that's down in Ellicottville or whatnot. Separate that into land, right? So then you have the 50,000 and the 450,000. So typically, right, the way that we would normally do this, if you're not doing a cost segregation, is that 450,000 gets streamlined over 27.5 years, and you can take depreciation of $16,000 a year over those 27.5 years. Decide to do the cost segregation and taking advantage of bonus depreciation. Say, for instance, that same $500,000 house with 50,000 land, they come in and they say, all right, well, you have 350,000 at 27.5-year property, but we have $100,000 of the under 20-year property. That $100,000 can be written off as an expense in year one, and you now have an expense of $112,000 in year one as opposed to $16,000. Yes, future years, your depreciation instead of being $16,000 is going to be that $12,000, right? So you're getting less in future years. But if you're doing this repetitively, at least one a year, you can just keep creating this loss year after year. And so that's when I say that short-term rental loophole, those who do one a year, they'll buy it, they'll qualify it, they'll take this, be able to qualify in it in the year that they do the cost segregation, take the bonus depreciation, hand it over to a property manager, rinse and repeat year after year, because you've just created $112,000 in loss that you can now take and offset your W-2 income, your interest income, your maybe your dividends that you're receiving, whatever it may be that you have, or your active business, right? Maybe you are a plumber, a carpenter. You can take this loss and you're basically offsetting $112,000 of income by doing this. Again, as long as you are either that real estate professional on the long-term rental side or that material participant on the short-term rental side. If you are not those, you do not get this benefit, right? Well, I mean, you can still do this equation, but that $112,000 loss is going to be limited by those different things that we talked about. Either you don't get it at all, maybe max out at $25,000 at most. Does this make sense? I know it's a lot to take in. I don't know if we're getting any feedback online or anything, or going through.
That'll offset the wholesaling and flipping income because it's still active.
Mm-hmm. Will essentially offset any income that you have coming through. You don't have to worry about the passive and active limitations that you would normally have because you've qualified in one of those two categories that we've talked about. So, thing is with this, you could do it years after the fact, right? I don't usually advise that. It becomes, well, messy for the CPA, and there's other pieces too. But it really depends on what were the depreciation rules on the year that you put it in service. So you may have bought a house in 2021 that this qualified for, right? Because we did have 100% bonus depreciation back 2020, 2021. And then it was going down 20% every year. Was supposed to phase out completely next year, but One Big Beautiful Bill Act brought that back. And what would happen is you may have taken regular depreciation, but you say, I want to do a change of accounting. I actually did a cost segregation. You can backdate it and then do the catch up of depreciation in that year that you're doing the cost segregation, and say, I'm catching up my depreciation. You can do that and be able to backdate it. It can become a headache, but if you think about it, if you're going 4 years back, a lot of that 5-year property, you're kind of already in a fully depreciated status anyway. So if you go back and reclass it as 5 years, you're going to get just a small benefit of it. So it can be done. Usually I say, do it at the time of purchase, right? Or shortly thereafter. So if you were to buy a property right now, qualify, you could have the cost segregation done anytime between now and when we're going to file your taxes, either April or if you extend to October, to be able to do that cost segregation. But because you put the property in the service this after January 19th, I believe is the cutoff date for the 100% bonus. As long as you put it in service after that date, and the cost segregation is done before we file your taxes, you can take advantage of this. So other advantages, right, just with talking about rentals is, and many of these that we talked about. So profits on certain rentals, you're typically not going to have that self-employment tax unless you're one of those providing the substantial services, then you're kind of throwing yourself into that. When you sell a property, right, as long as you held it for more than a year, you're going to get special capital gains treatment. So capital gains treatment is a lower tax rate than your normal ordinary income. So capital gains, you're either going to get taxed at 0%, 15%, or 20% based off of your income. But that 15% is going to typically be at the 22% rate or higher. The 20% capital gains rate is when you reach the 35% tax bracket. So you're saving on taxes by having real estate because it's going to fall into capital gains when you sell it and you make your money off of it. It's not going to be taxed at an ordinary income tax rate. On rental real estate, we'll talk about flips in a little bit. Great part of it is where it really comes out is when you're leveraging these properties, whether you're using a line of credit on it or doing a cash out refi. And you can, because those aren't taxable events, right? So you could pull money out of your rental real estate, the appreciation, whatever it is, pull that money out, and the money that you're pulling out is not a taxable event because you still own the rental real estate and you still have a loan on it. You haven't sold it, so you're pulling the money out, and you can go and use that line of credit, that cash that you got from the refi, and be able to grow your portfolio very quickly. Something that I work with a lot of my clients on is how to do that right. That's how I was able to walk away 3 years ago, is I was able to pull out a line of credit on my properties from the equity that had grown and use it for private lending, other real estate, other things, and do it that way. Could be something you just redeploy into more properties and do it that way. So, and again, that 100% bonus depreciation is back. So So I just like to try to bring it all together. I'll try to be quick with this, and this is kind of me being the wealth building part, right? This isn't really so much a tax piece of rental real estate. This is just where I say, like, so why rental real estate is the greatest asset class, in my opinion, right, to get into and to be able to see it, because when you look at the actual returns just past the cash flow, this becomes something significant. So we're going to use an example of $200,000 house with where you're putting 20% down. The rate is probably a little bit lower than what rates are right now, but we'll just use that as the example. So the first thing people usually look at, right? Oh, it's the cash flow. I'm doing well. I'm making $200 a month on this property. It's $2,400 a year. That 20% down payment on that. So you're basically your investment into this property. Real estate is one of the only assets that you can buy where you say, hey, I'm going to bring you 20% of what it's worth, and we're going to give you ownership of 100% of the asset, right? That's real estate is, at least as far as I know, the only asset class that you can do that with. So your investment in this is $40,000. So that $2,400 for the year that you got on divided into your down payment is a 6% return. Most of us are going to say, oh, a 6% return, I can do better in the stock market, I can do better than that. Why would I want to invest this piece of real estate? I'm only making 6% on it. There's 3 hidden pieces that exist in this, 2 of which we haven't talked about. The other one is depreciation, which I'll jump to because we just talked about it. That $200,000 house, just if you're doing 80% of it being attached to the building piece, is $5,800 in depreciation that you can take in each year, or in year one. That at a 24% tax rate is $1,400 in tax that you're saving. So that's the actual cash part, right, that you're seeing the benefit of. And so that divided by a $40,000 down payment, is a 3.5% return that you're getting just on streamline or straight line depreciation. That's not counting the cost segregation that we talked about. That's not talking bonus depreciation. That's not talking any of that. And so those 2 pieces are the cash that you see in your pocket every year, right? The 6% return you see on the cash flow is what you're getting on a monthly basis. The depreciation savings, that's tax savings that you won't see month to month, but you'll see when you file your taxes during the year. You'll get that money back because you're paying close to $1,400 less in taxes by being able to take that depreciation. So those are the 2 pieces that you see on a cash basis. The other 2 are the parts that are hidden, right? Like that you don't see on an everyday basis as you go through. It's not usually until you're looking at a refinance or pulling out the line of credit or trying to re-leverage that property or sell the property that you're seeing these returns. But they exist because they do happen year after year after year. So let's talk about mortgage pay down, right? As part of that cash flow that you're calculating, with that cash flow, you're paying your mortgage payment every month. That mortgage payment is before we talk about what's left net. So that $200 a month is after you pay your mortgage. But every time you pay your mortgage, your principal is being paid down every month. You're gaining more and more equity in that house every month that you make a principal payment. So in year 1, which we all know is the least amount of principal you pay on a mortgage, you're still paying almost $3,000 in principal during the year, divided by that same $40,000 down payment. That's 7.3% return, 7.4 that you're getting just on that. But that 7.4% return is the worst it's going to be from the entire time that you own the property, right? Because your principal goes up every year. So that's the worst that it's going to be. And then we have appreciation, right? So that's going to be your growth in equity too. Just take a basic 3% appreciation. This is the one, is the 3%, the 6,000, it's not on the 40,000, it's on the 200,000, right? It's the growth of the whole house. It's not just on the money you put down. So 3% appreciation on a $200,000 house is $6,000 divided by your $40,000 down payment, 15%. So just in year 1, the thing that you thought you were just making a 6% return, when we factor in all the pieces and we add it up, that's almost a 32% return in year 1. Which is typically going to be your worst year, right? Because that principal pay down, 3% appreciation that next year, 3% is based off of 206. It's not based off of 200 anymore. So that appreciation just keeps going up year after year. So the worst year you're going to have is year one, where you're making 32%. Granted, yes, only 9.5% you're actually seeing in your pocket, and you don't get to access the other 22% until you either refinance or sell or do that. But that's where I say that's where the leverage comes in, right? Because you can go back to the bank and all of these things that you just saw, you can go back to the bank, pull that equity out, right? And rinse and repeat, and do it that way and attain that. So yes, you don't get that 22% until you go leverage that property that you have, but it's happening in the background. And I don't know much else that you're getting. These aren't made up numbers, right? These aren't crazy numbers. This is an ordinary $200,000 Buffalo duplex, right? That you can probably go and buy for most of these terms that exist here. I'm not putting a crazy cash flow. $100 a door per month, right? That should be minimally your goal on any properties that you're buying. These are very low numbers, and you're still getting to a 32% return on that property. So this is why it's not a tax piece, but this is my piece of, right? And what I work with my clients is, how do we do this, right? When's the right time to refinance, to go expand your portfolio, or do you want to expand your portfolio? Do we want to do this to buy larger properties? We'll talk about a 1031 exchange and do stuff like that later. How do we make this work best for us in the most efficient manner, based on if you just want to be the passive landlord, or do you want to be somebody who really truly wants to grow their portfolio and take advantage of this piece?
Exactly. That doesn't even account for the bonus depreciation being factored in or cost savings, right?
Correct. Yeah, that's just the basic straight line depreciation. So if you think about it, right, in that last example that we just talked about, that 100,000 that you're getting so that 100,000 that you took, you may have on that $500,000 house put 100,000 down. So you could be getting $40,000 back in your taxes because you took that $100,000 write-off. Add that as a 30-40% instead of this 3.5%, and you're looking at sometimes a 70-80% return. People who do the short-term rental loophole, what they do is what they save on taxes in that year turns around and becomes their down payment, a large piece of their down payment for that next house that year, because they saved the taxes, didn't have to come out of their pocket. They now have that to go and do the next property. So.
And I can't stand real estate, but you're right. You can't get anything else that gives you anything like this. Like we just finalized the cost saving in this building, and I could not believe how much that was.
Mm-hmm.
Like if people aren't doing cost saves, they're missing out massively.
And it's tough in the Buffalo market, right? Because if you're paying $2,500 to do it, and you're maybe only looking at a $4,000 or $5,000 tax savings because of the low cost of properties here, sometimes it doesn't make sense to do it. But it lower than other places. It's not so much over the last 3 years, but that becomes a cost benefit analysis. But on as you're buying larger properties or more expensive properties, it makes more sense. But if you're going and buying a $100,000 single family and on the east side, you're probably not going to want to do a cost segregation because you're not going to get the value out of it. But the great thing about most of those cost segregation companies, they will do in 24 or 48 hours, they will get you an analysis on what they think. They'll give you a low end and they'll give you a high end. And then so you can look at it, hand it to your CPA, have it say, well, this is what your savings are going to be based on what they said on the low end and the high end. And then they give you the opportunity to say, yes, I want to go forward with it. Or, you know what, I don't think I'm going to get the benefit. And that first look back at the napkin calc is usually on the house. It's not something that they charge for. It's only if you choose to go ahead with it. So it's always at least even worth looking into on that side. So how are we on time?
You guys much time?
Okay. Well, I think we're good though. So just take everything that we just talked about now and just eliminate it from your head, right? Flips, yeah, handled very differently. There's, well, one, if you're flipping, you don't want to have losses to begin with, right? So we're not going to do that. You lose the ability to take any depreciation on things that you're flipping. So accounting for that, taxes, should probably at least have this change to taxes. But we talk about how to actually structure or how to manage it, because the accounting for flips is also not just the tax treatment, but how you track your property just to begin with is significantly different on the flip side. So I do like to do this because there are, right, rental real estate isn't the only real estate that's out there. There are many people who are doing wholesaling, that are doing flipping. So I do want to touch on this because there is some ways to still do tax savings with this world, but a bit more difficult. So really with accounting for flips, you want to take everything that you're doing throughout the process, and there's some categories you want to put it in. You want to categorize your costs. So you're going to have your purchase costs, which are just going to be, right, straight purchase plus any closing costs that you have in there. You're going to have rehab costs, which are rehab and repair costs. Most people think are the same. On a flip, for the most part, they are, but while you're tracking the costs of your flip, I say to try to, rehab would constitute more capital improvements. Repairs would be more your painting, you're doing small little fixes on the electric or the plumbing. And the reason you want to split those two up is just in case you want to turn this into, you say you get to the end of your flip and I say I want to turn it into a rental. Both of these get accounted for differently on your taxes. So that's why I say, just to make your life easier and your accountant's life easier at the end of it, tracking those two things separately will be key. You're gonna have your holding costs, which usually if people are doing that, it's your taxes that you paid, the interest if you had private investing. And then you're gonna have your selling price and then the costs that are involved with that, right? Your realtor fees, your lawyer fees, your different things like that, which would be your selling costs. So you're just gonna usually wanna categorize them. They're all gonna get treated the same way if you do the flip. If you do a full flip and take it from start to finish and buy it, do the rehab and sell it, they're gonna all end up getting lumped together. But it's key to, at least while you're tracking them, to keep them separate in case you decide to change your mind on what you wanna do with that property. So essentially what happens, all those expenses that we just talked about, all while you're working on the property are getting capitalized, right? It's all, you're taking your purchase price and then you're taking all those costs that are involved, even to utilities, the taxes, your holding costs, the rehab costs, and you're accumulating them over the course of the project. You don't, if say your flip goes from 1 year to the next, all those costs that you incurred in that year, that first year, say if you started now and it took you into 2026, you don't get to take those expenses in 2025 if you're doing a flip, because it's being capitalized, right? It's just rolling into this large number that is going to be there. The IRS doesn't want you to this year take advantage and write off all the expenses that you took and then wait to next year to take your income, take the tax benefit of the expenses, then take the income and pay more taxes next year, because you're getting to push your taxes back. You're not matching up your taxes and when your income and expenses are happening all together. They want it all to happen at the same time. So for a flip, they want you to keep track of all your expenses through the entire time of the flip. It gets categorized to be what your asset is. So it's going to be, say you paid $100,000 for it, you put $50,000 in labor and counting all these different expenses, and you get to $150,000, right, as your all-in cost on that. You sell it for $200,000. You're then going to, go to the next slide. You're then going to take that capitalized $150,000 cost, offset it against the sale that you made on that property, and then that's going to be what your taxable income is on that property. So again, they don't want you taking that $100,000 in cost this year, only maybe 50 next year, and matching that up against your 250. They don't want you to, they don't allow you to take that $100,000 offset expense to do that, and then take your taxable income next year. Because there's obviously every tax code or rule that exists is because somebody took advantage of it. So then they change it to, right, somebody finds a loophole and they try to close all the loopholes. So this is, they just want you to recognize your income, match your income with your expenses for the income driving activity that you have. That profit then is what you pay tax on. Problem is, the unfun thing, and also one of the biggest misconceptions that are out there. Oh, I'll hold that flip for over a year, and then when I sell it, it's going to count as capital gains treatment, and I get to take that special treatment of that. No, that's not the case. When you're doing a flip, when you purchase that property, if your intention is to flip that property, that's inventory to you. It's not a capital asset like a rental real estate is. You're not holding it for investment. Yes, you're doing it to make money, but you're doing it in an active business. So this counts as an active business. It doesn't count as that passive business. So if you're doing it on that basis, you're an investor, and then you're paying not only your ordinary income tax rate, but you get to pay that special 15.3% self-employment tax on top of it too. So flippers, on the most part, our count as active businesses, just as I'm a CPA, just as there's somebody who's a plumber, all of that gets taxed ordinary income tax rate and then gets hit with the 15.3 self-employment tax. So if you're doing this, right, that's because you're falling into a dealer status, essentially. If you're doing it over and over and over again, dealer status actually hurts you even more. But even if you're just an investor and you're doing 2 or 3 of these a year, you're still going to be counted as active income. And no matter how long you hold the property, it's all about intent. So if your intent was, when you purchased it and rehabbed it, was that you were going to turn it into a rental, you wanted it to be a rental, and then you spent over a year on it, and you're like, hey, I just want this to be gone, and you turn around and sell it, then it's going to be a capital asset that you did that because your intent was there, right? You have to prove it. You're going to have some exchanges with maybe your realtor or your lawyer that says, I'm buying this as a rental. To do that. But if your intent was to flip the property, right, buy it, turn it around, sell it, it's basically seen as if you're a business that holds inventory and sells inventory. And so you don't get any of those fun tax advantages that we talked about in rental real estate if you're somebody who does flips of houses. Doesn't mean not to do it, right? It still can be very lucrative. It can be something that you can make a lot of money on it. Just know you're going to be paying more taxes on it. There are many people who start out doing flips, doing this. They keep some of them, turn them into rentals, or use this to generate the cash that they need to go and buy those rentals. But most flippers I know that start off is that their goal is to ultimately keep more and more of those over time and turn them into the rentals, and do this less and less, or do this but on something they plan on keeping, like the Burr method, right? They buy it, they rehab it, they refinance it, right? And then just kind of rinse and repeat on that piece. So that's the differences, right? When it comes to here. Yes.
So if I buy a flip, let's say October, and I spend 70 grand on it, and then the next year I finish it in front of the market in January, sell it until it closes, let's say it's March, April, I only write it off that year.
Yes.
Even though I spent other.
Yeah. You should capitalize the $70,000 you spent this year to offset that sale price in March. Yep. So that's the proper way of handling it, right? There's, again, tracking of it is the key there.
So I can't write it off of my taxes the following year.
Yeah, I mean, you're not losing the ability to do it. You're just doing it at the year that you sell it, right? And I mean, in a way, you can decide, hey, I want to do that or I don't want to do it, because yes, you save on taxable income this year, but then you're going to have a much higher one next year. If you're rolling it, right, it comes out in the wash. If you're somebody who's doing flip after flip after flip, the first year you don't get to take the expenses, right? But then year after year, it's a cycle. So that's where you're losing it. But this is where, because active businesses where an S corporation election can come in, right? So this is something that can save on taxes, especially on the self-employment tax thing. So this is on active businesses. So this is something that's usually I talk about much more with people who have active businesses, plumbers, CPAs, realtors, different things like that. We have this conversation, but this does fit into flips. So I just throw this up in here. Don't dive into it a little bit, but just kind of can give you a few numbers on that. So as you know, with an active business, as we talked about it, right, you're going to get hit with your ordinary income tax rate that's here. 22 is just used a common rate that's there. But then because it's active income, you also get hit with this fund self-employment tax, right? It's both the employee and the employer side of, as if you got a W-2, right? Your Social Security and your Medicare tax that exists there that you have to pay because you're self-employed. You're responsible for paying the government as if you're an employee. So that exists. And so those two combined, right, become, and that's not counting New York State taxes that we get here for more, that you can look at, you're almost giving away 50% of your, it's 40% there. If you add in New York State, you may be getting close to 50% of taxes taken away from your LLC on your active business. But let's say we make an S-Corp election, which I usually say once you get to $35,000, $40,000 in net profit that you made that year in your active business, net profit, not gross. So what after expenses, what you're sitting at, that's where we start to talk about, hey, maybe it's better to move over to an S-Corp. So the requirements for an S-Corp is if you are taking any money out of the business, you have to pay yourself a legal, reasonable wage. And so if you're taking all of your money and reinvesting it right back into the business and you're not taking any dollar, you don't actually have to pay yourself a wage. But as soon as you take a dollar out of that business, the requirement of an S-Corp is that you have to pay yourself a legal, reasonable wage. But that's the part that comes into where this becomes a tax strategy to do this, because that becomes the only wage or the only money that you're making that you actually have to pay this 15.3% on it. Everything else is no. So the reason they say it has to be a reasonable wage is you can't just do you can't be spending 40, 50 hours a week in this role and only paying yourself $10,000. Just not reasonable, it's not okay. But if you have a $100,000 company, it's reasonable to say, all right, I'm going to pay myself $40,000. And that's kind of where I say if you have a full-time business, that $35,000, $40,000 is where we start to consider this, because that's about the salary that you would start paying yourself anyway. So that same $100,000, you say, okay, I'm going to pay myself the $40,000. That you still are going to pay the employer side of Social Security, Medicare. You still have to pay, just like when you get a W-2, because you will be issuing yourself a W-2, you'll have the Social Security and Medicare taxes that you pay on your W-2 as well. But then you still have $60,000 that comes there. So you're still going to pay the ordinary 22% on all of the $100,000 in income, but you're only going to pay taxes, this 15.3%, on the $40,000 and not on the $60,000. So instead of paying 15.3 or $15,300, you're only going to pay $6,000 in taxes on that $40,000, which then means those two, you're seeing a savings of over $9,000 in taxes by making just an election that means you have to file one more you have to file an additional tax return, right? Okay, I pay $750 to an accountant to do this, to file the additional tax return. And then you have to run a payroll, which if you do it once a quarter, you can find a payroll service for very cheap that will even file your employment taxes for you and file the forms for you. You can find one for a good $50 a quarter to run one payroll and do that. So for an extra, maybe $1,000 in increased costs, that's certainly a trade-off that I would make to save $9,000 in taxes. So I bring this up because this is any active business, right, can take advantage of this, but this is something where if you have a successful flipping business or you fall into that Schedule C that we talked about on short-term rentals, if you're the one providing substantial services and doing that, where if you're making a good amount in it and doing well, just simply making this election will help. Won't dive into details, but there's also more write-offs that you can get if you're an S-Corp. Augusta rule comes into effect. The ability to write off more things, have an accountable plan, reimburse yourself for your expenses rather than just take them on your taxes. There's a lot that can be built into that make you be able to take more deductions, but that's really getting into the weeds. And I just like to cover this basic part to the surface level piece, and then there's more that would exist here.
So say I switch us over to S-Corp and I made $100K on flip and I moved 40, paid ourselves. So now that's 60 sitting there. Is that basically locked in Like if I want to go buy a long-term rental or move it somewhere else, some other investment.
So, yeah. So the fun thing is an LLC and an S corp, the IRS is going to tax you whether you take that money out of the business or not. They tax you on your income. They don't care if you took it out of the business or you kept it in the business. The only time they care if you kept it in the business is that salary piece that we talked about. But you're going to get taxed on it anyway. So take it out, use it. If you're going to be using it in a different business, right, I'd say don't ever hold rentals, long-term rentals especially, or short-term rentals that are going to be on a Schedule E in an S corp. Because every time you do the leverage that we talked about, if you do you no longer are an owner, you're a shareholder. So what happens when you refinance a property, when you pull out money on that does become a taxable event. When you had an LLC and you were or yourself, that's not a taxable event. But because you're revaluing the assets, and this is then you're a shareholder, you then have to pay your portion of that increase in asset value. So 99% of the time, I'm going to say don't hold rental real estate in an S corp. This is something that is only going to be, you're going to want to do this for active income, not for passive. But yes, you can pull that 60,000, bring it to yourself, and then invest it into your LLC that you're buying long-term rentals with. Just have your separation of, try to keep your active business and your passive business separate.
All right, I got a question. Do people age on self-employment taxes after a certain age, after retirement age?
I don't believe so. It's a good question. But you're still going to be responsible for the employer taxes on it when it exists, because you're essentially still paying into Social Security and Medicare as long as you're there, even if you're at Social Security and Medicare wages. But I don't know specifically. I've not come across that. I don't know if you age out. So, what's that?
That was an online question.
Okay. Any others? Or go ahead.
Is it a good idea to have a flipping business and a construction business in one S corp, or separated?
So it becomes a structuring thing, right? A lot of it counts as kind of what are your profits going to be in each. What I say typically in planning, any person should only have one S corp. And what that S corp does is may own those two LLCs. So you have it, right? You have your construction business and your flipping business, each in an LLC, which are paying the profits up to the S corp where you take advantage of this. So the LLCs at the end of every year don't really have any profit because they're paying a management fee or some other fee up to the S corp. The S corp owns it. And then so the active income that you have in your LLCs, your S corp is essentially at that time kind of becomes a, like you, right? That's your personal management or family management.
Separate that into an S corp and then have two separate LLCs?
Yeah, so I would probably have a parent S corp that you're having. If you have multiple active businesses, your S corp would own those, and you're pushing the income up to that general S corp to take advantage of the benefits of the aggregate of all of your active businesses. Yeah. So I usually only recommend having one, because then in each business you're going to have to figure out your salary. If there are a whole bunch of S corps, you're figuring out your salary. But what you're doing is then on the salary on that parent S corp, you're deciding what that reasonable salary is to be managing the businesses, and it goes there. You don't have to separate a reasonable wage across multiple things. So
Another thing I've heard about S corps is they get audited less.
yes, significantly less, about 750% less. An S corp is 750% less likely to be audited than a general LLC. Yes. Yep. Because you're paying yourself that wage. For me, I think the IRS, one of their things they should build in the algorithm is they should take compensation of officers that you report on 11. So your S corp gets reported on 1120, and you have to report compensation to officers separate. And so if you took that compensation and divided it by net profit and came up with a very small number, every single one of those should be audited because they're not paying themselves reasonable comp, right? But for some reason, it's not in the IRS's algorithm. I don't work for the IRS, so I don't make the suggestion to them, right? But I'll say I work with my clients. There's a kind of a floating scale on that. I say you want to usually start, like if you're a 50,000 business, you can probably get away with 25. And then that percentage, that's 50%, right? Kind of keeps going down. And because once you're at a $500,000 business or more, paying yourself much more than $100,000, there's like, you're running a beneficial like a big business. Just because you made $1 million versus 500,000, I don't think you have to pay yourself more. Like, so you kind of cap out at a spot. And then as you make more, the percentage that you're paying yourself is less and less there. So.
Can you add like a family member? Can you add like a family member, like let's say your wife as a second booster account?
So you can, well, I mean, you're going to, by paying, you have to have a reason, right?
That's just the account.
Yeah. So if you put your wife into it right now, you have to pay her a reasonable wage and you're paying more in that self-employment tax there. So I say if the reason that you're doing it is to start putting, if you put her entire salary into a 401k and you're going to take the tax benefit on it immediately that first year, do it. If she's for some reason needs specific medical benefits or something that you're wanting to pay for her because she's an employee out of the business, do it. But if you're just solely just giving her a paycheck, you're paying more in tax because you're paying 2 W-2 wages, that 40,000 twice instead of just once. And that money's coming into the familial unit anyway. So there are sometimes that I say pay a spouse if you have an S Corp, but it's if you're taking advantage of like a tax advantage retirement account, some sort of medical benefit, some sort of benefit that they're only getting because they're an employee of the company that you wouldn't have been able to give them if they weren't. So usually I say only try to pay yourself. Obviously, once you have employees, you're going to want to pay your employees and stuff out of there. But if you're at that just entry level where you're the only employee, that's where you start.
Yeah, well, like I have my wife on the books for retirement also, but I have a C Corp, so I know that is there a 20% like that pass through for
Well, the QBI?
option? Yeah.
Yeah, so QBI,
Apply to that on, I know it does on a C Corp, doesn't do that on a LLC here.
yeah, so QBI would apply to the net income piece. So that's somebody who makes the argument against the S Corp is say, well, I lose out, there's 40,000 that I don't get QBI on, right? They can only take that 20% discount of income on the 60 instead of the 100. But when you do the math, okay, so now I'm saving maybe only 7,000 in taxes versus 9,000, but you're still saving, right, a pretty large chunk in taxes by doing it that the QBI doesn't make up for it. That's why I say usually you want to get to that $40,000-$45,000 threshold to where the additional expenses of having an S Corp are outweighed by the additional, the savings that you're going to have in taxes.
So if, let's say my salary is 40,000 and I need another 20,000, can I just pull that out?
Yep. It's a distribution versus payroll, and it's avoiding that there. So the tracking is that you track your wages and you track your distributions. It's 2 different buckets instead of where in most LLCs, everything's just an owner draw, right? So you create 2 different buckets. Wages get hit that extra 15.3, all other distributions, it's just that you've already paying the ordinary income tax rate on it. So on that, this is where we're kind of going to circle back to the rentals, right? Because we're really not going to be able, as we talked about it, we can't really defer taxes on flips, right? We're kind of paying it as it sells, its inventory, we're paying that there. So I'm going to touch a little bit on ways that you can defer tax on the sale of that, because on the other end, right, taking that bonus depreciation is awesome. You get to take those losses, you get to do all that. But when you sell your property, you have to pay all that depreciation back. You have to pay tax on all that depreciation you got to take to the government. Because they say, you got to take this benefit, but you know what? You took the benefit, you're going to pay it back, but you don't pay it back at capital gains tax rates. You pay it back at your ordinary income tax rate or 25%, whichever is lower. So you would max on the depreciation recapture, you're maxing out at 25%. Or if you're in a 22 or 12% tax bracket, you're paying less. But so where, right, we can keep kicking the tax can down the road. Greatest tax planning measure, everybody is usually not happy when I say this, greatest tax planning measure when you own rental real estate or any capital assets is to die. Really, for tax-wise, because your heirs inherit your capital assets at the fair market value at the time of your death. So you could have depreciated the crap out of that property over the course of time, had $1 million property that now, according to your books, is worth $10,000 because you've depreciated everything. When you die, your heir gets that at whatever that property is worth when you pass away. No taxes, no anything. They can turn around and sell that the day after they inherit it, and they pay no taxes on it, no matter whether there is depreciation or not. It disappears into the abyss. They do not, no. So you do not get to do bonus depreciation on any inherited property. So that's just where, if you want to still expand your portfolio, still maybe get into different properties, but don't want to die, you can defer your taxes by doing a 1031 exchange. So this will take that capital gains tax and depreciation recapture that you would normally have and kick it down the road. There are certain ways to qualify for this, right? It's not just an immediate thing. You have to make sure you check the boxes. But this allows you to maybe consolidate multiple properties that you have and maybe buy a large complex, right? Or a large commercial building or something like that. Or vice versa, maybe sell one property that you have and turn it into multiple properties. And we'll kind of talk about how this exists. But this is not only a great tax plan measure, but this is also a great way to really level up if you're wanting to build your portfolio in real estate. We'll see that in a minute. But what it allows, right? So you do have your basis. I don't know if you guys are familiar with basis. When you purchase a property, that's your basis in the property. All upgrades that you make to it, capital improvements, increase your basis. But at the same time, while you're depreciating the property, it's depreciating your basis. So your basis is moving every year. It's plus capital improvements minus depreciation to where your basis is. Your sale price minus your basis is what your gain on a property is. So you can take that gain and push it down the road. Part of it is so that deferred gain is something that you can't redepreciate, you can't do anything with it. But say you have you're leveling up on the property. You're selling a $200,000 house and you're using that $200,000 to go buy $1 million property. Any amount above your deferred gain that you're kicking down the road becomes something that becomes eligible for that bonus depreciation, right? It's a new asset. It's an increased asset that you haven't gotten any tax benefit out of. It didn't exist to the government. So your increased part of your basis that you were eligible for can swing right back into those bonus depreciation numbers that we talked about and implement there. You can't bonus depreciate everything, right? Because you still have that deferred gain that they're not going to give you the benefit of. They're not going to say, hey, you get to kick taxes down the road, but then you also get to write off more of your property. It's just going to be the incremental amount. But if you're buying a much larger property, that number could be pretty substantial.
Can that be multiple properties or just one?
What's that?
Can that be multiple properties or just one?
Yeah. Yep. It's just going to be the basis, the rollover. You compare the basis and it's basically basis plus deferred gain. Compare that to your purchase price, and the difference is what can be set up, new depreciation, essentially. So there's rules that exist with this. When you're going to be selling your property, you have to you can't ever receive the cash from the sale of your property first, right? Have a qualified intermediary that's handling it. You can't touch the cash because as soon as you touch $1 from the sale of a transaction, you've now eliminated this, and you're going to have to take the capital gains and the tax on that. So use a qualified intermediary. You have 180 days from when you sell your property to purchase the next property. So that money, if you sell your property, it goes to the QI. They hold on to the funds and then use those funds to go and buy the next property. You're going to want to typically make sure that there's a lot of rules to it. You want to make sure that your loan on the new property is not less than the loan that you had on the property that you sold, because then you're going to have boot, which is gain. So you're going to something you're going to have to pay tax on, and you're also going to want to make sure that property that you're buying is worth more than the one you just sold. Because otherwise, then the difference, the cash that you're receiving, right? If it's buying less than what you just sold, you're going to have to take some cash, and you're going to have to do that. There's times that you have to identify properties. You can do a reverse 1031 where that 180 days can go the opposite way. Those are a little bit more complex. But say just make sure you're going to use a QI and also work with a CPA or tax professional on this. But it's a great way to really level up. And I'm going to go to the next slide and kind of show you where. So let's use an example of a property that the gain that you would have normally paid tax on it is $400,000. Say it was a $500,000, you sold it for $500,000 and your basis was $100,000. And you're going to pay a $400,000 gain on that property. If you just sold it and you didn't want to buy any property, and you decided, hey, I'm out of the real estate game, your tax liability, I have tax rates behind this that is like state versus federal to where that number comes from. But say you're going to pay $140,000 in tax on that $400,000 in gain that you just had. So after you pay your taxes, you have $260,000 sitting in your pocket when all is said and done. So that $400,000 you made, actually, you only made $260 because you got to pay IRS and the state $140. You then decide, okay, maybe I did want to do real estate, right? And I want to buy some more property. You take that's your 25% down payment. The $260 that you have buying power to go in and buy a little over $1 million property. By that $260 that you have, typically, right, you're going to have a 25% down payment. Say you decide, no, instead I'm going to sell that same property, but I want to do a 1031 exchange, which means I'm not going to pay any tax. I'm going to actually defer it. I'm going to kick it down the road. So that property that you're selling, the $400,000, you're going to have that in your pocket instead. Take that $400,000 versus the $260 you have the ability to go and with that same 25% down, go buy a $1.6 million property, right? So this could be, say this is a property that you're selling here for $250,000 that turns in and it becomes $1 million property that you maybe want to buy here, or you maybe want to buy somewhere else. You want to buy a 4-unit, an 8-unit, something like that. To be able to do that, it's where I say, or maybe you want to buy 4 $400,000 properties to get to that 1.6. So you've now turned one $400,000 property into 4 of them, right? So this is your level up, and you didn't have to take any tax consequences at all. Yes, you're going to have new mortgages, right? So you're going to want to make sure your cash flow exists, and you do that. But as long as that box that we showed with the 4 different returns that you have, if you're now getting that 30% return on 4 properties instead of 1, you're growing your wealth significantly, right? That 30% is on 1.6 in property. It's not on 400,000 anymore. So it's a way to, there's a strategy here, right? I've seen it where somebody's usually they're holding property for 5 years. They're doing this, and then the math works out with historically how appreciation has happened in the United States, and that with depreciation in that you can take that one house that you just had for 5 years, be able to sell it and turn it into 3 after 5 years with no money out of pocket, being able to kick the tax on the road and have 3 properties that were now worth the same, that are worth each the same equivalent as the one that you had. And so, right, if you have 3 properties, you now just have in 5 years gone from 3 to 9 that are all cash flowing and giving depreciation basis and doing that. or you pick one or two of these that you do a cost segregation on, right? We just talked about that $400,000 gain. If you buy a $1.6 million house, you could have $1.2 million that you can go and cost seg and bonus depreciate this year. And even put money in your pocket, right? Because you now just saved a ton on taxes and no money came out of your pocket and you just turned one property into four or one property into a much larger one property. This is obviously, you have to want to stay in real estate, right? A 1031 exchange can only be done with a property held for sale with another property held for sale. It can be from residential to commercial, it can be residential to oil and gas, mineral rights, right? 1031, it's a property that's being held for investment. So it doesn't have to be one for one. It just has to be something that falls into a capital asset that is held for investment.
Yeah, can you
Sure.
repeat that again? So you can go from a real estate property to an oil investment?
Correct. Yep, you can 1031 that money into the, like if you're going to do an oil and gas, yep, you can 1031 into that because it's property held for investment. So yes, that does exist. Obviously, it changes your basis that you're not going to get that full write-off that you get as part of the oil and gas piece that you would because it's going to be based off of that smaller basis. Like you could only depreciate the basis. Yeah. But right, it's if you're going to get a portion of that still, and if you hit oil, right, the income that exists from there. So, yeah. So yes, but that is one thing that's actually his presentations he talks about like this is something that is eligible for 1031s. Yeah. Yeah. So if you want to you have four short long-term rentals that you want to turn into a big commercial building, right? You can go that route, or vice versa. There's ways that again, as it falls into that same asset category that you can do the exchange.
What if they don't sell all at the same time? Let's say you have 4 apartment buildings and they all think one gets delayed, one.
Yeah, so you got to fall into that 180, and if for some reason one doesn't complete in time, you're going to end up probably paying the tax on the one that didn't make it.
You have to make sure it makes it.
Yeah, do what you can, or then I could call it the lazy man's 1031, is those taxes that you just had to pay on that property. Go buy another one, do the cost segregation, match up the capital gain that you just had on that property that didn't make the exchange, take the bonus depreciation, match those up, and you still have a replacement property. The math may not work out exactly, and you did pay the tax, but you now have an asset. So the tax consequences can still be the same. You're paying the tax, and then you're just making sure you purchase an asset, going through the hoops that we talked about to take the loss to offset that capital gain that you took.
Is there any consideration given that attorneys don't seem to want to close any damn properties sometimes?
Unfortunately, no. Yeah.
They can't close it in-house on time ever.
So when I say usually with this is have a property in mind already. Know that you're already going to be close to in contract with something that you're like, right? Whether it be like a seller financing type thing or somebody where you know that you have the property. Because like you said, right? If I sell my property now, I could look for 6 months to try to find a replacement property and struggle to do so. So most people will do this, will go and find a property that they have an offer accepted on, and then they'll turn around and say, I'm going to list my property, I'm going to sell it, and I'm just going to work with the attorneys to make sure mine sells either before or after, right in that same time, so that you can use the.
But something like the oil would be a scapegoat if for some reason you did run up against time.
Yeah.
Do that in a week.
Yeah, because there's also trusts that exist, right? There's also larger investment groups that you can 1031. If you get yourself in a bind, I know there's 2 or 3 places that you invest in a portfolio that is all real estate activity that gives you a dividend as it. So there are other things that you can, if you get into a bind, that you can turn 31 into. So there's ways into it. There's different things. So it does take some planning, but it is a pretty awesome tax thing. It exists now. One of the candidates who was just in our election wanted to get rid of this is the platform that, well, he then she was running on, and wanted to eliminate 1031s, right? Because this is a huge wealth building piece. You don't pay your taxes. One of our two parties that exists in the United States wants to get their tax now, right? They want to do that. So any tax loopholes like this that exist. So I say, right, take advantage of this now and think that this might be something that you want to do, but know in the back of your mind that there may be a chance that 1031 exchanges do become something that may not exist in the future, but I can't say for sure. And a lot of it will depend on who is our president. As a lot of tax codes, like a lot of the tax code that we talked about earlier today, definitely in place for the next 4 years. After 4 years, some of that might change and might be different, but all I can do is plan and talk about the things that currently are offered to us now there. And so just the other thing kind of on that is, say maybe you want to get out of real estate. You don't want to do a 1031 exchange. You don't want to do that. A way to defer taxes is you can do, say, seller financing. You can be the one who finances that, sell it that way. And so what that is say you finance a 30-year mortgage for somebody, and the property that you're selling, you can take that gain and you can defer it over the 30 years of that mortgage, right? Because you're accepting the payment over 30 years, right? You're not getting that full payment right at the start. You're doing it where there's going to be a portion of principal and a portion of interest, and that so you're going to be able to defer that gain. Usually when you're seller financing, you're kind of doing a 5 or 10 year term, and so that's the rate that you're going to be able to do that.
Can you do that if you're already in a 1031? Let's say you're in a 1031 and let's say you're old and you don't have anybody to, if you pass it on to and you're gonna die and lose it all. Can you do the seller financing when you're in a 1031 to defer that taxes?
Yeah, so you're gonna, like if you did a 1031 years ago, so you have a lot of deferred taxes built up. This would be a way to kind of not take it all in 1 year and to say, I'll pay it over the next 10 years. A lot of this is done kind of late age, right? Because this becomes a retirement thing. Instead of taking all that money and paying tax on it now, I'm going to take seller financing where I'm getting a monthly payment. That's what I'm living off of. The only caveat to this is that the depreciation recapture that we just talked about, usually you have to pay that back in first year. That doesn't get deferred over the say 10-year mortgage or 30-year mortgage. You have to pay the tax on the depreciation recapture in year 1. It's the remaining amount that then gets deferred over the period of time of that.
So that's pretty much when sub-2s became popular.
That's a way. Yeah. Oh, the sub-2s are usually if people are underwater, right? And you're assuming somebody's mortgage. It's not usually, seller financing is involved in sub-2s in a way, but sub-2s don't usually exist for people wanting to defer taxes. It usually happens because somebody's underwater or can't afford their house any longer. And then another way, in kind of the same way as seller financing, you can do a structured sale. So you kind of do it the same way. Like if you don't want to because in a seller financing, you hold the mortgage, right? So you're responsible for having to foreclose. You're responsible for having to do all that. What you can do is you can do a structured sale. You use an intermediary. Intermediary receives the funds, and then say maybe like an annuity distributes that money to you over the years. And again, you still receive, you take that gain and defer it over the length of time that you're receiving the money. So it's a tool to defer it. I'm still a huge fan of the 1031, but there are, say you don't want to be in real estate anymore because the 1031 requires you to buy a replacement property. There are some ways to still defer gains and do that over the course of time there. So this is a little bit of a kind of taking the number, there's numbers attached to what we just talked about, but just know this is kind of taking into that $300,000 gain, but I did put a lot of it going to recapture. Like this was the depreciation that you took over time. But even on where that 220, you're still paying this, it would normally be $73,600 in taxes on this if you're doing it right now. The depreciation recapture you'd have to pay in year 1 is $61,600, but then the deferred taxes would be $12,000. Obviously, if your depreciation was a lot less, this number would be a lot less and this number would be a lot more. It just depends on the property that you have there. But you do have to pay the depreciation recapture in year one. You'll have to pay that tax. And then the deferred part would be, that $12,000 would be over, if it's a 10-year loan, you'd pay $1,200 in tax every year over the course of that. But you'd be getting interest income as well if you do a seller finance, because that's separate. It's the principal part that's the taxes. The interest would then still be extra income that you're getting there. So that's that. I know it's a lot.
Have you ever done like instead of doing a 1031, doing a, a refi on a property to expand your?
Yeah.
Now, how does that work out compared to like doing a 1031?
It really is like any new purchase or new properties that you're buying, right? If you're doing it without a 1031, you're getting that increased basis. So you're not having to deal with that carryover low basis that you may have. So it really becomes a math equation at that point in time, right? And so to do a refinance, right, you're probably increasing your debt on that as opposed to qualifying for new debt on the new properties. So it depends. Are you going to use that as a down payment on future properties? It becomes a math equation when looking at the properties that you have. What's going to change in my cash flow if I do it this way versus this way? And what are my ultimate goals? So what I did is I took a line of credit out on my properties and then used that for down payments on future properties. But you could also accomplish the same by selling one of your properties and rolling it. So the negative of what I did is I did a line of credit on my properties. So now if I sell one of those properties, I have to redo my line of credit because that asset gets taken out of the equation. And so I have whatever they gave me as my appraised value on that, the 80%, I'm going to have to pay that back if I close. So it's less cash for me to roll over. But I also did that line of credit 3 years ago. So right now it's 5 properties that are in there. If I sell one of them, I just have the other 4 reappraised, and I'd still have the same line of credit because the increased value of the properties. So it's that analysis, right, becomes one where we sit down and say, what do we want to accomplish? What's going to be the impact of this option versus the next option? And that's why you reach out to me. So this is my information, my phone number, email address, and then the one sub. I know when I talked to Brandon, he said he was going to post that in the chat, but I send it to him. So if that can be posted in the chat, that link will take you to booking either a 30 or 60-minute meeting with me. Typically, we'll just have a discovery call, usually a short 15-minute call to make sure, hey, what are you trying to accomplish? What are we going to talk about? And then from there, say, hey, we want to work together, and then roll from there. So like I said, I do the tax preparation, right, because we've done the planning and advising all year, and the preparation becomes very easy. But my focus is always going to be on these topics, right? Talking about the things that we can do, where we can save money. And this is very real estate focused, but the same conversations I have with people who even aren't in real estate that just have small business as to, hey, do we want to employ children? Do we want, or not even employ, do we want to pay our children? How do we do the Augusta rule? Is it something that we can take advantage of? Does that S corporation fit your business? There's 30, 40 topics that only 3 may fit you, but each of them may save you 2, 5, 10,000. I had a close friend of mine who didn't want to show me his books. Wanted me to give him general tax advice, but never wanted me to prepare his taxes because he didn't want me to see it, right? And he had a $400,000 LLC, $400,000 profit LLC that he was, as an LLC, wasn't an S corp, and just simply us taking a look at it, making the S corp election saved him $40,000 to $50,000 a year in taxes that he was paying just by changing his structure, literally filing one form with the IRS and one form with New York State, and paying himself a payroll is the only changes that we made, and it saved him that amount just on a single conversation. So if you're happy with your CPA, awesome, love it, use them, keep going. if you think, hey, there's some things here that you just talked about that he or she has never mentioned to me, let's have a conversation and see, what changes or what things might exist. I don't want to actively steal anybody from their CPA. Again, if you're happy, cool, do it. But if you just even want a second look or what have you, I'm available to talk.
Can
So
we do the child pay to grandkids?
you have to pay your kids first, and then your kids should have to have a separate, not a separate LLC, but a separate entity that then pay your kids. You can't pay your grandkids directly. You have to pay your kids first, qualify it that way, and then they pay your grandkids. But usually that becomes a tax planning measure, because for somebody who's at a higher tax rate, you pay, so it becomes an expense to you, so you save significantly in taxes. And by the time that it gets to the person who is actually receiving the money, they're at a significantly lower tax bracket. So for family-wide, you've paid less tax on the same dollar. Because say if you're at a 35% tax bracket and your 19-year-old grandchild is at a 12% tax bracket, what you paid them, they're going to pay the 12% on to save you from paying 35% on it. But they actually have to do something for the business, right? You can't just pay them. That's a gift, that's separate. But yes, if they're shredding documents, cleaning your office, visiting with you at the property and say cleaning property with you, different things like that, as long as and you have to pay them the right wage. You can't pay them $100 an hour to shred papers, right? You have to pay them what would be a right. But there's also a lot of people will use their children for marketing, right? Do it that way. Those rates are much higher, because then that's Screen Actor Guild's rates that you can find and do it that way. So there's people do it that way, or children are usually much more better with social media and doing that. So maybe you hire them to handle some of your social media, to post things, to do that. Find things that are reasonable, and then there's a huge tax incentive if done right? Like, just don't blindly do it. Definitely consult somebody to do it. I mean, we've done it right with your daughter. Your daughter has paid kids out of the business and done it that way. But for you to go directly to the grandkids there's a step that has to happen on the parents' tax return. They basically set up a Schedule C. They report the income that you paid them, but then they have an expense that matches that up right there, and then their Schedule C shows a zero profit. So they don't pay tax, and then they report the income down to their children. There's just steps you have to do. So.
But in all real, like, being real, how many of you meet with your CPA quarterly for tax plan? Anyone?
You do, because I'm your tax. Yeah.
So no one else meets with their CPA or tax professional quarterly?
Everybody.
I just talked to a guy today whose family, is worth, I think, $11 billion. And I'm not gonna get into how much he makes, but he called me about tax strategy, which I just said what I did. He meets with his accountant one time a year to give him the info and file taxes.
Mm-hmm.
Blowing me.
Scary, right? Mm-hmm. But there's a thing like that. I'd say that close friend of mine, I even, now that he has the S corporation, I say, all right, well, let's get your family on a board so that you can do a family or do a board meeting once a year, be able to take the expenses related to that. Let's set up, he entertains for Bills games, and most of his clients or his customers are friends, right? So to be able to implement that, but he's very happy with, no, I saved that whole bunch on tax. That all sounds like too much. I'm fine. But right, that he may be that way, but I have to tell him every year there's still multiple thousands of dollars that you're leaving on the table. But for some people, they want to. I see him on a monthly basis, and I say, hey, are we going to sit down and talk about those things? And he's like, So it's about want to, but when you can attach the numbers to how even just a small change, like I said, that's even that S corporation, that even 100,000, saving $9,000 in taxes just by making one small change. Not every change you make is going to be the same significant value there, but I mean, even if you pay a child $10,000, if they earn $10,000, if you're at a 22% tax bracket, you've just now saved $2,200 in tax. And if they're under 18 and they're below the standard deduction threshold, they don't pay tax on that money. So again, you've saved yourself $2,200, but you've not increased anybody else's taxes that way, just by making a lot of tax strategy is not making any changes, right? It's just doing the same thing, but finding the code that makes your saving, puts more money in your pocket at the end of the day.
Just a mind shift, just like.
Mhm. The ethics part of the IRS says they want you to pay the least amount of tax that you're responsible for. It's up to you to figure out what that number is. If you pay them more, they're not going to say, hey, you paid us too much, here's this. If you paid them below what you're supposed to, they're going to find you eventually. But they want you to pay that, and they incentivize small business and real estate, because the IRS the government wants you to go buy real estate and go be entrepreneurs. And so they incentivize that so much in the tax code that you just have to know the boxes to check and the things to do that allows you to take those deductions and pay less tax.
I see a lot of presentations on taxes, and I mean, I came a little late, but that was super good. Like, just the way you kind of explained it, and then you broke down the numbers. For me, that was really helpful seeing the numbers. I thought that was great.
Any other questions? Anything online? Good? All right.
People are just happy with what you said.
All right, cool. Take it. Yeah. Yeah, and also, right, if you have a CPA, or you have, right, we have 20 something days left, right? A lot of tax planning measures, a lot of things that you can do. When January 1 hits, it takes away the ability for you to do things that can save in tax. There's still some things you can do, like, hey, I want to put into an HSA. You can do your 401k late. You can do IRA contributions late. Like, you can do some of those things late up until the time that you file your taxes. But there's a lot of things that if you haven't done it by December 31st, the ability for that benefit to hit this year has evaporated. So if you do have an accountant that you work with and you haven't met with them yet, or talked about things, do that now. So, all right. Well, thank you guys.
Thank you.
Yeah.
Thank you.